Worst nightmare. A trusted employee robs your company blind, doing it right under your nose while you are supposedly running the show. Sadly, that's exactly what happened to the Jacksonville Jaguars with their virtual card program. In this follow-up broadcast, we'll take a deep dive into the control weaknesses that allowed this devious employee to cause havoc. Stay tuned until the end when we share some valuable tips on how you can protect your organization from similar insights. This update includes issues that have come to light after our initial taping on this topic. Lynn, I thought he manipulated various aspects of the virtual card program, yet he's charged with wire fraud and making an illegal monetary transaction. Can you explain that?
I had the same reaction you did, Mary. I was like, what is this all about? The wire fraud charge, I mean, basically just stems from the fact that he stole money. So I've seen this applied in other card fraud cases as well. So it's not that unusual. But what had stumped me initially was the other charge has to do with illegal monetary transaction. And the prosecutors or whomever's behind these charges, they were looking at in particular his purchase of that really extravagant watch, which by the way I've never heard of, but it was over
I
90,000.
I've heard of it.
Well, I'm not the fashionista apparently, but it was over $90,000. So it was that purchase that he did through an online store that was based in a different state.
Okay.
And it became like under the heading of interstate commerce, and so that's what led to that other charge.
Okay, so that's kind of interesting, and I thought some of the things that he procured were interesting. So what exactly did he get?
I don't know if we even have a complete list. I was struck by the condo in Florida, which obviously, this goes back to how did he do it? Because you're not going to purchase a condo with a credit card, a virtual card, plastic card. But he got a condo. It was the luxury watch, which we already mentioned. It was a Tesla sedan. It was a Nissan pickup truck. It was a country club membership. He even bought cryptocurrency. Sports memorabilia. He did, spa treatments, concert tickets, sporting tickets. I think he even retained a criminal defense lawyer through these means.
Well, that was pretty smart, that last purchase on his part. So I've read that his lawyer has said that 99% of the losses were due to gambling losses, but $22 million was lost. 99% of that is, I don't know, over $21 million. It seems like all the stuff you talked about was more than $1 million.
Well, I think it goes back to what you and I were even guessing before more details came out, that he was likely using one or more virtual cards that he probably issued to himself to go to these online gambling sites. Because again, it's a virtual card. And by the way, this type of virtual card, we mentioned in the first broadcast, is pretty much like a corporate card, just in a virtual form. It's a different form than the virtual cards accounts payable might be using to pay invoices. So I just want to differentiate that. But he went to these online gambling sites, and I think that's how he was, losing money, gaining money, getting cash ultimately to make these purchases.
Okay, so I want to talk a little bit about staffing. In theory, this shouldn't have gone on so long. Can you explain how it happened?
Yes, in theory, right? And I think this is one aspect that every organization can certainly relate to. It was a change of staff. It was employee departures, and not just one person, although I did read that even the direct supervisor that he had left, it sounded like soon after he took this particular role within the organization. So that person wasn't replaced. And then there were various other employee departures within the realm of the accounting department. And again, they weren't getting replaced, so they were short-staffed. And I would then argue, then clearly no one was looking at what were the duties all these different people were performing, and where did it go from there. So when you start losing more and more people, then the controls that you thought you had starting out have suddenly disappeared. And unless you are doing, like a regular risk analysis, risk assessment every year, coupled with some auditing, process auditing, you may not even realize what has happened. Although when someone leaves, obviously someone should be looking at the duties that they're leaving behind and figuring out what to do with those.
So, Lynn, I'm curious. Do you recommend that when someone leaves a position like this, that they do an audit?
Well, I think that's a good idea,
Right.
certainly. But again, I think there should be ongoing auditing. I think there should be an annual risk assessment. Once you do, one risk assessment, it's a matter of updating it every
Mm-hmm.
year. You've got a script to go by, so to speak. But
Mm-hmm.
yes, when someone leaves, look right away at what they've been doing.
Right. Of course, that. All right. So, for those who are listening and watching and don't know Recharge Education's Lynn Lawson, she is one of the leading card experts and regularly guides organizations of all sizes on card program issues and best practices. And it's why I'm so thrilled that she was willing to come and talk with us about this. So, Lynn, I know you can block transactions on P cards. Can you give us some examples of what best practice companies typically block on their card, be they virtual card or a regular P card, and comment whether you think that would have helped?
Well, first, generally speaking, most card issuers will automatically block for you, for an organization, the categories that are really deemed high risk. And then from there, an organization can choose to block additional categories. And when I say categories, I'm referring to merchant category codes, also known as MCCs. And it's basically a number that represents the primary business of a particular merchant. But there's really an inexact science to this. And as a prime example, I'm aware that one of the major online gambling sites, it's not like they are labeled as a casino or anything that screams gambling at you. Rather, it is under something generic like digital goods, something very just you wouldn't expect it. And so, to your question of would that have helped? Well, maybe not, because not every merchant that you are purchasing from has a really specific merchant category code that would scream, block me. I
Yeah,
might be a source of fraud. So, it's a good control to use, but you have to
it's
realize
not
it's
perfect.
exactly, and people can go overboard in trying to
Yes.
block everything, and then you start blocking some legitimate transactions, which ultimately hurts your program as well.
I would think that most companies would block cash. People can't
Right.
cash. I would think that they would block casinos. But again, to your point, that would have to be the merchant category code that the online gambling site used. Probably liquor.
Yeah, and again, it goes back to ask your card issuer when you are establishing a program which merchant category codes (MCCs) are blocked automatically, and usually it is cash, casinos, things like that. And then from there, work with them to identify other ones that would be best for your organization, depending on your business, to block as well.
So to now stand up for them a little bit, to stand up for the Jaguars, I'm guessing they probably would not want to block casinos because I think at least a few of the sports stadiums are they located near a casino and they might be staying in the hotel?
Well, right. I think, in this particular example being the NFL, I mean, their travel could look
Right.
very different from just a different type of business in their travel. So, again, we still have to rely on very good auditing to, detect
Right.
things that might be happening inappropriately.
Yeah.
Yeah.
So are there any reports that they could have pulled, the company could have pulled, maybe from the card issuer that would have helped uncover this faster?
Well, you hit the nail on the head again. An auditor, someone totally separate from the person running a program, a card program, should be the one who is going directly to the issuer system. They have lots of reporting tools and pulling data that way. I think we even talked about that in our first podcast. So you do want to be pulling, the top suppliers used, and you might be looking at card holders. So that's one. I recommend that again, someone other than the program administrator or manager be pulling every month a list of the new card holders or new cards issued or new accounts. Again, giving it a review, to see if it's appropriate. And that may or may not tell you something, but it's another thing to look at if you're not expecting, well, in this case, this gentleman, if you're not even expecting him to have a card at all, and he would show up on a new card or new account report, then that would be a red flag. So that's another one. And I recommend always, if an organization can swing it, using the help of some kind of third party auditing solution to try to, uncover things. And I don't know, we have a tip, I know, Mary, at the end maybe for what smaller organizations can do if they, can't afford one of these services.
Okay, so before we get to other controls that should have been used, if you are finding value in this broadcast and or are interested in the most current best practices impacting both the accounts payable and payment function, including cards, please hit the subscribe button. Hitting the notification bell will also alert YouTube to send you a notice whenever we post new content, which we do 2 or 3 times a week. Alrighty, Lynn, so if you were running this show, what other controls would you have put in place to prevent this?
Well, we know we have to start with separation of duties. We, talk about that till we're blue in the face. As we just mentioned, there are different reports that someone other than the program administrator should be actively reviewing. There should be appropriate oversight by this person's, the program administrator's boss as to what their employee is doing. And I know we said that person left and they didn't replace that person. Well, he still reported to somebody. So,
Right.
It's up to an organization to figure it out. And also, sometimes organizations get so focused on transaction auditing. And if they were using the data that he was providing, remember, he was falsifying data, adding transactions, changing things, that wouldn't have helped. You have to go back to the source. But also look at the whole process. So now I'm going back to this whole concept of doing a risk assessment or a risk analysis of the program. And that uncovers things like separation of duties. Is someone verifying the grand total as well as some of the details before they're paying the issuer? For example, looking at the top suppliers used based on what the card issuer system says and comparing it to what your internal system says. So there has to be some comparisons there. So maybe now's the time to bring up that other report that I alluded to. If you don't have a third-party auditing solution, you can use a basic tool like Microsoft Excel, where you could be, getting an Excel file, CSV, from the card issuer system. You can be pulling something similar from your internal systems. If you combine those together and then do, one of the options in Excel is conditional formatting.
Right.
And you can have it highlight the duplicate values, like in the merchant column, the supplier column. And, then theoretically, everything should be a duplicate. If you've got, all the same suppliers on both, from both systems, if anything is not a duplicate, then this would highlight someone has manipulated or changed the data. So once you have it highlight duplicates, then you can sort by a cell color. It's not like you have to hunt and peck
Right.
through everything to find what's different. But using tools like that will really, get you to where there are some discrepancies, we'll say, between those two systems. And that could have uncovered what he was doing right away if it was done every month.
So, Lynn, we have a broadcast on using conditional formatting, and I'll link to it in the description if
Perfect.
anybody wants to take a quick look. All right, Lynn. So now I know some organizations do credit checks when they hire new employees, but I'm thinking that might not have helped here, because do any companies do ongoing credit checks?
That's a good question. Some organizations that I have worked with say they only do credit checks if someone is in a position that handles money or handles payments, which would have applied in this particular case. But still, it doesn't always mean anything. I mean, I know people who have a poor credit rating and it's a result of, like a family dynamic, like a
Right.
divorce or something like that. And it
Medical
doesn't
bills.
Exactly. I mean, it doesn't mean that, they're a risk. Now, would this gentleman's, severe gambling issues have come up? Maybe. I mean, I don't think it hurts to do a credit check on people that are handling funds, handling payments, but you have to be careful about jumping to conclusions. Just very
And
cautiously
work with your
approach that.
HR department to make sure you dot all the I's and cross all the T's about the right way to do this.
Yes, you have to get their buy-in, make sure you're doing it appropriately. You can't just have one person act, oh, they have a bad credit rating, we
Right.
can't hire them. You have to have like a script. You have to have, what are you going to do in these different situations? So you also have a very consistent response to what you're finding. Whether you're talking about credit check results or even audit results, you can't just jump to conclusions. You need a very methodical way of approaching it, because sometimes organizations just jump right in and think someone's committing fraud, and you have to be careful. You could ultimately say or do something that would harm like a criminal case if you so
Right.
want to be building one down the road. So
Right.
don't just start accusing somebody or, jumping and going rogue.
You're right. Or even worse, you alert the criminal and they destroy all the evidence.
Right, exactly. So,
Yeah.
be very careful. Have a plan in place that you can turn to when these situations arise.
All right. So, as mentioned several times during this session is a follow up to initial talk Lynn did with me actually last week. This case highlights some very interesting control weaknesses, one of which revolves around regular card audits, which Lynn has also mentioned several times. Lynn joined us recently to discuss card audits in more detail, and of course, last week to talk about this case. Links to both of these programs should have appeared on your YouTube screen and are in your description. Protect your organization by watching both of them right now. Good luck.